Hi guys, today we'll be looking into a headline of related to HDFC Bank which actually caught attention of many people. The headline goes as HDFC Bank records loan growth of 7% while deposits rise by 15.4%. So let's see for this sole headline, nothing else, just this headline means. This actually says that the deposits which are like a liability for a bank rose by 15.4% while the loan that acts as a source of income for a bank rose by just 7%. Just telling you the meaning, not to interpret anything from this, because for interpretation you need to have some other data related to past figures of loan growth and deposit growth. So yeah, for that let's go to the slide. In this chart now you'll see why this 7% is a big deal. You see year loan growth which has been always in double digits, even till 61% it has gone, but this time it's just 7%. Yeah, that's why it's a big deal. So you must be thinking, oops, this is a bad thing. No, wait, hold back your horses. Don't jump into any conclusion. A wise man once said it's the mark of an educated mind to be able to entertain a thought but without accepting it. So let's go back into its history. On July 1st, 2023, HDFC Bank merged with its parent company HDFC Limited, and now just HDFC Bank exists. So after this merger, the assets as well as the liabilities both came into the balance sheet of HDFC Bank. And what happened is the cost of funds increased from 4% to 4.8%, and credit to deposit ratio rose to 110% post merger. Now, what this means is that how much percent of deposit has been given out as loans to the customers. So a 110 ratio means that the bank has issued more credit than the deposit it holds, definitely creating potential liquidity concerns over a long run. And a CD ratio above 110% is not at all sustainable. Definitely in long run, in short term maybe bank can manage few things, but in long run it definitely ain't sustainable. And yeah, and then you can see that in these charts also CD ratio 110, it has been reducing 99. We'll see these things are speaking something I know. Let's talk about this. So to cope up this problem of 110% CD ratio post merger, the management came up with few strategies. First one was securitization. This actually means is that a, the bank bundles its loans and sells them to investors. This provides the bank with immediate funds, allowing it to reduce its CD ratio, basically reducing its loans. And second was the banks decided to focus on increasing deposits, because once again deposits will increase, so CD ratio will come into a sustainable range. And the third thing was intentional slowdown of loan growth, because this was mandatory. You see, loan growth was never a problem for HDFC Bank, but this time they definitely had to slow down. So, because more than profit, what is important is sustainability. Like it's not that na कि one year you are earning too much and the next year then bank just closes or any company closes. You have to be sustainable. Okay, so these are the three strategies adopted by the management, broadly three strategies. So that's why now you see that 7% is not a problem. Actually, that was all under control, all done intentionally. That's why just by reading the headlines, you could have gone into making wrong decision. Maybe see some of these headlines from few trusted sources. In Mint, the said in financial year 25 we would probably grow slower than the system. In FY26, we may be at or around the system growth rate, and by FY27, we should be faster than the system growth rate. So, right now, it's all under control. No need to panic. Now, another headline said, which was about the securitization, which I mentioned in the last slide. The HDFC Bank in talks with global lenders to offload 84 billion in loans to improve CD ratio. The third, HDFC Bank's sequential rise in deposits outpaced loans growth in Q2. You see, nothing to worry, at least from this headline. I don't know about other metrics. I just wanted to show you like how actually a headline which might seem negative at first might be a good positive thing. So definitely you should not rush into any decisions and do thorough due diligence. Now once again you see this chart now won't be looking like any problematic to you. It's all under control. Yeah. And one more thing that might benefit this bank. No, I am not saying this is any type of like any proof for that, but just on my analysis and of basic concepts of economy, you all know that have been chances. US already has reduced its interest rates, and India might also follow after some time. Definitely not ekdam se, but after some time. So at that time also, HDFC might benefit because loans will get eventually will get cheaper. So people who maybe have been holding as of now just have as a like restricted themselves from not taking loan because they want to take the benefit of interest rate reduction. That is the repo rate reduction by our RBI, and just waiting for loans to get a bit cheaper will rush into taking the loans. And at that time, because already the deposits would have been in an abundance, so bank will have a more space to give out the loans in bulk, like it can meet all the customer demands. So this is also a like good thing for the bank. Nothing has been mentioned about it, but it is